The credit markets have sharp antennae. They issued early warning alerts 4 to 8 weeks before each episode of stress over the last 20 years, although with several false alarms along the way. The shakeout in the U.S. junk bond market last week had an ominous feel for traders and may finally mark the top of the post-Lehman boom in corporate credit. The exuberant reach for yield is nearing its limits. It is a sober moment. People are suddenly aware that central banks are turning serious and are not going to keep creating stimulus ad infinitum, said Mark Ostwald from Admiral. The metric watched by markets, the Bank of America Merrill Lynch high-yield option-adjusted spread, has jumped 40 basis points to 3.8% over the past 2 weeks. BlackRock's iShares HYG fund, the biggest exchange-traded fund, ETF, for junk debt, fell to a 7-month low on Friday. The electric power group NRG Energy pulled a $870 million, $1.1 billion, bond issue citing market conditions. These moves are not large by past standards, but they bear watching. This sell-off is not isolated to the US. My intuition is that something broader is happening, said Peter Skafrick from RBC. The iTraxx X crossover index measuring bond risk in Europe jumped 25 basis points to 248 over 5 trading sessions. Michael Hartnett from Bank of America advises clients to keep buying the dips for now, describing this as a dress rehearsal for a big correction in global asset prices next year when the world passes the point of peak monetary stimulus. His Icarus trade lives on. The bank's bull and bear indicator of optimism is 7.2. Still short of a screaming sell signal above 8.0. Institutional investors are holding back 4.7% in cash and are not yet fully committed. Keep your nerve until it falls to 4.2%, says Mr. Hartnett. The initial trigger for the latest jitters was a shift at the Bank of Japan, which is having second thoughts about purchasing $4.5 billion a month of ETFs under its quantitative easing program. The BOJ's statement said extreme measures aimed at boosting inflation endanger financial stability and could do more harm than good. The cautionary words comes after several weeks of reduced purchases by the BOJ. The warning hammered the Nikkei index, although it is still up 18% since August. The BOJ owns 72% of Japanese ETFs and is crowding out the public share float of substantial companies such as Fast Retailing, TDK, and Trend Micro. A parallel shift is underway at the European Central Bank, where several governors suggested a total halt to QE as soon as next September. Ireland's central bank chief Philip Lane said there were signs that inflation was snapping back and warned that the ECB might have to tighten sooner than people expected. The coup de grace came from Washington, where the Senate Republicans rejected the House bill on tax reform, demanding a delay in corporation tax cuts until 2019. Gridlock on Capitol Hill has chilled animal spirits, so far mainly in the credit markets. The S&P 500 equity index is less than 1% from its peak. The plan to cut corporation tax from 35% to 20% has been a crucial prop for Wall Street.